In this instance, I am taking 2 years after acquisition. Let's look at an example. Here's John's company and here's Sarah's company. John bought Sarah's 60% equity at $700. John made a journal entry, debit investment in Sarah $700 and credit cash $700. Sarah's company made a journal entry, debit cash $700, credit equity in Sarah $700. When we combine the two general journal entries, the combined journal entry is debit investment in Sarah $700 and credit equity in Sarah $700. It is that journal entry we must reverse, but in detail. Additional information tells us there was an asset plant that was not revalued. It should be revalued by $100. Remaining useful life is 10 years. Goodwill has impaired by $30 in the first year, and it has further impaired by $20 in the second year. So here's the John's company, or the parent. John is there, and here's the Sarah's company, and there's John and Sarah. John owning 60% and Sarah owning 40%. Here's the group. In that, John appears once only, and Sarah as well is in the group. When we record our journal entry, because this has happened over 2 years, we have to note some mileposts. Date of acquisition is 1st of July 2012, and then the first year ends on 30th June 2013. Anything that has occurred during that year is recorded under retained profits of that year. That is opening retained profits for the current year. And the current year begins on 1st July 2013 and ends 30th June 2014. Let's look at the consolidation entries. The first one, fair value adjustment. Debit plant 100 to increase its value. Credit revaluation surplus 100. Because we increased the carrying value of plant compared to the tax base, we must look at the tax effect and credit deferred tax liability 30% of 100 and debit revaluation surplus 30. Because the plant was revalued about 2 years ago, that amount of 100, which is not recorded by the subsidiary, recorded by the economic entity only, must be depreciated by the economic entity or the group. So the depreciation expense over 10 years is 10 a year. We record debit depreciation expense 10, and the previous year's depreciation expense we record under opening retained profits 10, and we credit accumulated depreciation 20. That gives rise to a tax effect when we increase expenses, profit decrease, income tax expense decrease. So 30% of that. Credit income tax expense 3, and we debited depreciation expense into opening retail profits, and the tax effect of that, the income tax expense of that, will be recorded under opening retail profits credit 3. We can see accumulated depreciation 20 has decreased the asset value. That means it has decreased the deferred tax liability. 30% of 20 is 6. So our journal entries: debit opening retail profits 10, debit depreciation expense 10, credit accumulated depreciation 20, debit deferred tax liability 6, credit opening retail profits 3, credit income tax expense 3. Next, third one, we eliminate the investment. Investment in Sera is 700. Equity, John acquired. The book value of equity is 1,000. 60% of that is 600. The revaluation surplus for Sera's company is 100 minus 30. Group did it, but for Sera's company. So that revaluation surplus is in the Sera's company, and John acquired 60% of that 70. So we are now eliminating that, reversing that. And that is 42. And the remaining amount is for unidentifiable assets that John paid for, and that is a collection of intangibles, and that's called goodwill. Debit goodwill 58. So the third entry, debit goodwill 58, debit Sera's equity 600, debit revaluation surplus 42, and credit investment in Sera 700. The goodwill has impaired in the second year. It is 20. We record impairment expense, and it also has impaired in the previous year, and anything that has happened in the previous period we record under opening retail profits, and we debit 30 opening retail profits, and that reduces goodwill, and we credit goodwill 50, credit goodwill 50, debit impairment expense 20, debit opening retail profits 30. Just for additional information, goodwill impairment is a permanent difference, and it is not a temporary difference.